Let's continue our discussion from the last issue. After talking about the gold-silver ratio, let's take a look at the supply and demand relationship of silver. Silver has dual attributes that gold does not have. It is not only a monetary metal that has been passed down for thousands of years, but also an indispensable key material for modern industry. It is this unique dual identity that constitutes the most solid foundation for this round of bull market. Unlike any previous rise driven by investment demand, the current silver market is defined by a structural and irreversible physical shortage. The silver market is facing a physical supply gap that has lasted for many years, that is, the global total annual demand, industry plus investment, continues to exceed the total supply, minerals plus recycling. This gap is constantly consuming the world's above-ground inventory, providing a solid bottom support for price increases. According to data from the Silver Institute, the global silver market will have a supply gap of up to 148.9 million ounces in 2024, which is the fifth consecutive year of shortage. The core force driving this gap is the nearly rigid industrial demand from emerging industries. The photovoltaic industry is the fastest-growing engine for silver demand in recent years. Global solar installed capacity is experiencing explosive growth, with 597 gigawatts of new solar power generation capacity added in 2024 alone, up 33% from 2023. Authoritative organizations predict that by 2030, the annual new photovoltaic installed capacity may reach an astonishing level of 1 terawatt. More critical is the intensification of demand. Contrary to the common belief that technological progress will reduce material consumption, i.e., thrifting, the current trend of photovoltaic technology development is precisely to increase the amount of silver used per unit of power generation. In pursuit of higher photoelectric conversion efficiency, the industry is turning from traditional PERC cell technology to more advanced TOPCon and HJT technologies. The amount of silver paste used in these new technologies is much higher than that of traditional technologies. Although some manufacturers have reduced the silver consumption of HJT to less than 7 mg per W through technical optimization, this is still an area of continuous technical competition. However, the general trend of the industry's migration to higher efficiency cells, usually meaning more complex silver paste lines, is clear. This reveals a disruptive fact: the race for energy efficiency is driving the endogenous growth of silver demand. The photovoltaic industry's demand for silver has formed a huge, deep well of demand. This demand is price inelastic. Silver is an indispensable material for the manufacture of solar panels. Even if its price doubles or even rises several times, its cost still accounts for a small proportion of the total cost of the entire panel. Therefore, manufacturers will not stop production because of rising silver prices. This rigid demand provides an unprecedented solid bottom for silver prices. A study by the University of New South Wales even predicted that if no effective alternatives are found, the photovoltaic industry may consume 85% to 98% of the world's silver reserves by 2050. The electrification of the automotive industry is another powerful long-term demand driver. Due to the large use of silver contacts and conductors in battery packs, electrical control units, inverters and charging facilities, a pure electric vehicle, BEV, uses almost twice as much silver, about 25 to 50 grams, as a traditional internal combustion engine car. With global electric vehicle sales expected to reach 30 million per year by 2030, this sector will create a steady and growing source of demand for silver. In addition, silver has the best electrical and thermal conductivity of all metals, making it irreplaceable in cutting-edge technology fields such as 5G communication base stations, high-density semiconductor chips, and high-performance data centers required for AI. The electronics industry is the largest industrial application of silver, consuming more than 445 million ounces of silver in 2023. With the advent of the Internet of Everything and the era of artificial intelligence, the demand for silver will only increase with each passing day. Due to growing industrial demand, the supply and demand situation of silver has continued to be in a structural deficit for many years, which means that the world is constantly depleting its savings account of stock silver. Although this process is slow, its cumulative effect is amazing. The relevant data of the World Silver Institute shows this trend intuitively. The cumulative inventory change since 2010 has dropped sharply from about minus 100 million ounces at the peak of prices in 2011 to nearly minus 500 million ounces in 2022. This clearly shows that the global silver inventory is much more depleted today than in 2011. This inventory depletion is also reflected in the registered inventory data of major exchanges such as COMEX and the London Bullion Market Association, LBMA, which are the main sources of meeting the large-scale physical delivery demand. So there is a profound logic here that may detonate the market. Industrial demand is stable and continuous. It is like a slow but never-ending river, consuming the world's silver inventory day after day. In order to maintain production, industrial users must constantly extract physical silver from the market. Investment demand is cyclical and explosive. It is like a sudden tsunami, triggered by macroeconomic fears, such as recession, war, and monetary policies, such as interest rate cuts, quantitative easing. In the past, the huge above-ground inventory was like a huge reservoir that could easily absorb the impact of the sudden outbreak of investment demand. Today, however, the water level of this reservoir is being continuously drained by the river of industrial demand and has dropped to a historical low. When the next wave of investment tsunami driven by monetary easing and risk aversion arrives, it will hit a reservoir that has been almost drained. This competition between industrial, rigid demand, and investment, explosive demand, for increasingly scarce physical inventory is the recipe for a perfect storm. By then, price fluctuations may far exceed any previous bull market. You have to know that the total value of all silver ever mined is only about $1.8 trillion, which is a drop in the bucket compared to the size of a U.S. stock market, about $55 trillion, or the bond market, about $53 trillion. Even if only a small amount of funds rotate from these mainstream assets to the silver market, the impact will be subversive. Next, let's discuss how monetary policy shapes the fate of silver. If industrial demand builds a solid foundation for silver prices, then monetary policy is the catalyst that ignites the rocket. As an asset with both commodity and monetary attributes, the price trend of silver is closely related to the policy trends of global central banks, especially the Federal Reserve. Looking back at the market dynamics in 2020, we can clearly see the display of this logic. The market crash caused by the COVID-19 pandemic prompted the Federal Reserve and the U.S. government to take unprecedented monetary and fiscal stimulus measures. Trillions of dollars of liquidity were injected into the market, directly igniting the bull market in gold and silver. The price of silver soared from $14 per ounce to $28 in just a few months, doubling. A similar script is likely to be repeated in response to the next recession or market crisis. Faced with downward economic pressure, the Federal Reserve will almost inevitably be forced to pick up its old toolbox, interest rate cuts and restarting quantitative easing, QE. Based on information as of mid-2025, the Fed's policy is at a delicate crossroads. Despite the upward revision of inflation expectations due to factors such as tariffs, Fed officials have hinted that a rate cut before the end of the year is still possible. Economic data is mixed, the labor market remains solid, but economic growth has shown signs of slowing. At the same time, trade policy, tariffs, and fiscal policy, growing deficits, bring a high degree of uncertainty. This state of driving in the fog makes the Fed's policy path full of variables, but the overall direction is to ease. However, the impact of monetary easing this time may be very different from that in 2020. This contains a deep logical shift that is extremely favorable to silver. In 2020, the Fed's stimulus policy was like a flood, raising the water level of all assets. Not only did precious metals rise, but the U.S. stock market represented by technology stocks also soared and set new highs. But today's situation is completely different. Analysts believe that the U.S. stock market, especially the Big Seven technology, is already in a huge valuation bubble and is facing the dual pressures of trade wars and deteriorating fundamentals. Therefore, when the next round of quantitative easing and interest rate cuts arrives, these funds are likely to no longer be willing to flow into those overvalued and risky technology stocks. Investors will have to find new and safer places for their capital. Against this background, precious metals, especially silver, which is still severely undervalued, will become one of the preferred destinations for capital. This means that, unlike in 2020, silver may no longer have to compete with a booming stock market for funds in the next round of easing cycles. The flow of capital will be more concentrated and more focused on hard assets. After the bursting of the internet bubble in 2000, the trend of funds rotating from technology stocks to precious metals is likely to be repeated on a larger scale. By then, the driving effect of monetary policy on silver prices will be greatly amplified, forming a powerful positive feedback loop. Okay, let's talk about this first, and we will continue next time.